Thanks for tuning in. My name is Josh Schneider, Investment Advisor, Director of Retirement Plans here at Everoak Wealth. I'd like to take a few minutes to speak directly to something that's on many people's minds right now: the markets, the headlines, and your retirement savings. There's no question we are living in uncertain times, from rising interest rates and inflation to global tensions, wars, and even tariffs. It can feel like there's always something new adding to the anxiety. And if you've looked at your retirement plan balance recently and felt concerned, you're not alone, and your feelings are completely valid. Saving for retirement is an extremely large commitment requiring discipline and patience. It is completely normal to feel uneasy when markets are bouncing around and headlines seem more stressful by the day. We all want to feel safe, secure, and on track. You're working hard, saving diligently, and naturally, you want to know that your money is safe, that your future is secure. Again, you are not alone. Let me say this clearly. Uncertainty in the market does not mean your plan is broken. It means you're experiencing a very real and very normal part of long-term investing. Let's look at this chart. Annual returns and intra-year declines going all the way back to 1980. This chart illustrates the annual return for the S&P 500 each year through 2024 and year to date through March 31st, 2025. The gray bars represent the market's calendar year return, while the red dots represent the largest peak to trough decline at some point during each year. Almost every calendar year experiences a decline at some point of more than 5%, while declines of 10% or more happen in about half of the years listed. However, full year returns end up positive in 34 of the 45 years shown. This shows quite clearly that historically, we should not let negative economic headlines and market dips derail our investment approach. The truth is, markets have always gone through ups and downs. They've weathered wars, recessions, political changes, pandemics, and yes, even inflation and interest rate spikes. But over time, markets also tend to recover and reward patience. Let me say that one more time. If history is to repeat itself, markets tend to recover and rewards patience because retirement savings is a long-term journey. The next chart provides historical context to support this point, illustrating the volatility of stock returns, the green bars, bonds, the blue bars, and a 60-40 balanced stock bond portfolio being the gray bars. This is illustrated over different time periods, 1, 5, 10, and 20-year rolling time periods, going back 75 years. As you move from left to right, the bars represent longer periods of time. The bars on the far left highlight how returns can fluctuate significantly within a single year. Stocks have ranged between 52% to minus 37%, while bonds have varied between positive 33% and a negative 13%. As the investment horizon lengthens, volatility decreases dramatically, and long-term outcomes become more stable and favorable. For example, there was never a single 5-year time period since 1950 that a balanced 60-40 portfolio resulted in a negative return. Consistent and uninterrupted time in the market remains an investor's best friend. If you're feeling anxious, here are a few things I encourage you to consider. Stick to your plan. Market volatility is unsettling, but reacting emotionally can often do more harm than good. Focus on what you can control, things like your savings rate, your asset allocation, and your spending habits. These matter more than the headlines. Reach out if you need reassurance. You don't have to go at it alone. Leverage and seek resources to help make sense of the noise and stay focused on what matters most, your future. The bottom line is you are not alone. You've taken important steps by saving, planning, and investing for your future. That takes courage and wisdom. Yes, the markets may be uncertain, but your retirement strategy doesn't have to be. So take a deep breath, stay the course, and remember, you're doing the right things. Remember, it's times like these when saving into a retirement account can be most impactful because you're able to buy more shares of the same mutual funds through the same payroll deductions because share prices are depressed. Taking advantage of market declines is when consistent and meaningful contributions tend to be the most beneficial. Thank you for tuning in, and on behalf of all of us here at Ever Oak Wealth, have a great day.